Welcome to our YouTube live, and we'll be talking about what the Fed's just said at its latest monetary policy meeting and its FOMC policy meeting. So let me just outline what I'm going to do. So I'll just summarize the points that they've made. I'll give my take on it, and then I'll answer some of your questions, and Laura will be fielding that. Let me just say as well that I'm going to be doing one of these for the UK, for the Bank of England next week after they announce their monetary policy as well, because I realised that we're Brits, so it's interesting to see what our Bank of England is saying as well. So let me start off by just going through some of those kind of take-home messages that we got today from the Fed. I think firstly, the Fed did what people expected, which was not to change rates. They kept rates at between 5 and 5.25%. That's their main policy rate. And that's what markets were expecting, so no surprises there. The economic points were kind of interesting. Inflation surprised the Fed, I think. If you look at the summary of economic projections, which they've just updated for this meeting, that showed that they've revised their inflation expectations upward. Unemployment was surprisingly robust, so they expected it to be higher, unemployment to be higher than it actually was, and growth as well surprised on the upside. So I think the Fed has been surprised by how robust the US economy has been, despite the fact that they've been tightening monetary policy, and inflation, core inflation, remains stubbornly high. It's a theme we'll return to as we go through the economic data in a moment. Powell stressed the fact that they've raised monetary policy by 5 percentage points since early 2022. And what was also interesting is that they expect more tightening to come, even though they've kind of paused for now. So if you look at the summary of economic projections, they expect that we're going to end the year at a higher policy rate than we are now. The median, I think, was 5.6 for the end of this year. And so that's, maybe even two rate hikes from where we are today. So no member of the committee expected a cut in the policy rate over the course of this year. So if you see markets expecting that, it's very much at odds with what the Federal Reserve is saying. The other point is that we're going to get another monetary policy meeting in July, and Powell stressed a couple of times at least that will be a live meeting. What the Fed means by that is that, anything could happen. They could increase interest rates again. It's not just to kind of, we'll just skip this time. It's more a matter of, we'll just take the data as it comes, and it may well be that we raise rates again. The pace of increases now are slower. So if they did raise, it would be by 25 basis points, 0.25%, rather than 50 basis points, unless there was a surge in inflation, which nobody expects at the moment. But July is still a live meeting. That's one of the things he stressed. So I think that kind of summarizes, where the Fed sees the economy. Fairly good growth, surprisingly robust growth. Unemployment remains low, and the labour market remains tight, and there's that sticky core inflation which doesn't seem to be going away, and which seems to be very resilient to tighter monetary policy. So maybe more medicine's required. So let me just go through some of the things which the Fed, some of the data that we've seen recently as well. So let me just minimize myself here and make this bigger. And I'll be jiffling myself around to skirt the actual numbers on the slides. Okay, so every morning of each policy meeting, I take a snapshot of what markets are expecting is going to happen to rates. Now, this is how it looked before the February meeting. So they expected rates to increase to between 475 and 500 basis points. Then it would stay there until September, and then the first rate cut would have come in November of this year. That's what the expectation was. Then at the next meeting in July, things changed pretty dramatically. They expected rate cuts to start much sooner. The first one they thought would be in July, because they thought the economy was broken and the Fed would have to fix it by cutting interest rates again. But the Fed stressed the fact that it would not do that. It would keep rates high because inflation was still very high at that point and still is. Then in May, which was the previous meeting, then people were still expecting that the first rate cut would be well before the end of this year in September, and then there'd just be a successive cut of 25 basis points for every meeting until June of 2024. So again, hugely at odds with the message that the Fed was giving. But finally, we're kind of more in line with what the Fed's saying this morning. So what the market was expecting was no rate hike today, which is what happened, and one more rate hike in the July meeting, the one which Jerome Powell said is still live. So, maybe that's the last rate hike in the cycle. It really depends what happens to core inflation, as we'll see. So that's where we are now. And markets are still expecting the first rate cut to happen in December. Powell made it very clear that none of them agree with that. So if cuts are going to happen, they'll be in 2024 or later. And they'll only happen if core PCE, core personal consumption expenditures inflation, starts to show a meaningful fall, which it hasn't happened yet. There's a nice little thing which Nick Timraus does in his Twitter feed. He's the journalist from the Wall Street Journal who covers the Fed, and he shows the changes in language between each meeting. And what's noticeable this time was obviously the fact that they'd hold the target range steady and allow the committee to assess additional information and implications for monetary policy. In other words, they're going to wait and see what happens. That was the big change compared to the previous meeting in last time around. So this meeting also, we got an update to the summary of economic projections. Some people call this the dot plots. And what you can see here is this is a kind of table which summarizes it. And what you can see is every committee member puts one dot on the chart, and then they take the median. So the one that people usually look at is the median here. And they have a forecast for GDP, unemployment rate, personal consumption expenditures, inflation, the headline number, and then the core, stripping out energy and food, because they think that's a better predictor of future inflation. And they also have a forecast for where they expect monetary policy to be in each of these successive points in time. So 23, 2024, 2025, and over the longer run. And they also have this kind of dispersion of the estimates. So sometimes it's displayed as a dot plot, sometimes not. But what's really notable is they also show you the previous meeting where they had the summary of economic projections, what people were expecting in the committee. So what do we see for GDP? Well, that's been revised upwards, as I say. That's more robust than the Fed was expecting. They presumably thought that tighter policy would have a bigger effect, a bigger negative effect on growth, but that hasn't happened. The economy's been pretty resilient. And so they've upgraded 2023, they've slightly downgraded 2024, and 25 hasn't changed much. Unemployment, they've reduced the expectations from 4.5 to 4.1% because the labour market still stays in pretty good shape in the US. There's still a big demand for people to work. There's a big demand for lots of roles for people to work and an insufficient supply of workers to fill those roles. So that's been revised downwards. Unemployment, which is inflationary, of course, and PCE inflation has been revised down slightly. But core PCE, which is the one they care about, which strips out energy and food, has been revised upwards for this year, not for next. And then the federal funds rate has actually been revised upwards because of those changes. Tight labour market remains, core PCE inflation remains high, not much progress there at all. So that's been upgraded for 23, for 24 and 2025. So the Fed's now expecting things to be tighter. So how will the equity market take this? Not good is what I'm guessing, because core PCE inflation has disappointed the Fed, stayed there, and they're expecting policy to be more aggressive and higher for longer. And equity markets don't like that. So let's look at those dot plots for the monetary policy. Now what you can see here is that there is quite a bit of disagreement between the FOMC members. Each of these dots is one of their forecasts for one member of the committee. And what I've shown here, the numbers are the median forecast that we saw previously. So that's the 5.6, 4.6, 3.4 and 2.5 for the longer run. And you can see the dispersion becomes really large when we go to 2025, presumably because expectations about inflation and how quickly it's going to fall vary widely between committee members. So if they don't think inflation is going to come down, they'll probably be on the hawkish side, the higher rates here. If they're kind of more dovish, then they think inflation will come down faster, and they'll be on the lower side here in 2025. But yeah, sure enough, nobody expects a rate cut or rates to be below 5% at the end of this year. So no rate cuts by the end of this year. Some of the committee, about half, a little bit more than half, expect rate cuts next year, by the end of next year. And almost all of them expect rate cuts by the end of 2025. One member doesn't, which is kind of interesting. And this is what they expect rates to be at the end of the cycle when things are back to normal. So centered around, 2.5 is the median. So yeah, what's the problem? Well, the tight labour market is certainly one of them. So if you look at this statistic, which is one that Jerome Powell really likes, which is the number of unfilled job vacancies per unemployed person, for a long time it was hovering around 2-ish. It's fallen, it's been fairly volatile, but it's fallen to 1.7. So not as tight as it was previously. A big number means it's a tight labour market, but still remains pretty tight. So less tight, so it is loosening, but it is still very tight overall. So lots of jobs, very few people, not enough people to satisfy all of the demand for workers. So the labour market, according to Powell, is still out of balance. Still a bigger demand than supply of workers, and that's inflationary. So, that's one of the reasons why he thinks inflation's remaining high, particularly for services. So if we zoom in on that, you can see it more clearly. What I was trying to stress with this graph is that the shaded regions are US recessions. The time when that number goes down is when there's a recession. There hasn't been a recession since this spike happened. So maybe that's what it'll take to get the labour market back into balance. Usually that's what it takes. So I'd be surprised if it was different this time around. So there will have to be certainly a period of weak growth, maybe full on recession, in order to get this number to come down and for the labour market to go back into balance in terms of supply and demand of labour. If we look at non-farm payrolls, which is the number of jobs that the US economy adds every month, so this is the absolute number of workers in the top panel. The number that people usually look at is the monthly change. So if this is going up, the monthly change will be positive. 100,000 is the number needed just to absorb people leaving school and just to absorb new Americans, if you like, into the labour market. But this has been well above that number for some time. So if we look at the last three prints, it's been 217,000 to 294,000 and 339,000. So the latest number was a pretty big one. So if this number's big, it suggests that there's a big demand for workers, and the Fed is certainly not going to want a strong payrolls number. It wants that to weaken or even go negative. It has in the past. So Yeah, not helpful in terms of tight labour market. It's going to stay tight if payrolls remain strong, which it has so far. And if we zoom in on that, just so you can see the more recent data, you can see those 3 recent prints. It did look like it was going down after this monster print in January, but then it started to pick up again over the last 2 months. So not good news for the Fed. Another point here is that what the Fed is trying to avoid is a price wage spiral. So what does that look like? Well, what you'd look at would be the CPI number. So what I've done over here is the yellow line is CPI inflation. The blue line is the annual increase in average hourly earnings. So think of that as wages, right? So this is wage growth is the blue line. Yellow is the rate of inflation, headline inflation. Now notice how much this picked up, the wage growth, after the period in 2020 when lots of people were laid off, often very low paid workers. So this was a compositional effect. Poorly paid employees were fired, and that tended to push up the average hourly earnings. And then that went into reverse as those people went back to work once the lockdowns ended. But what's really shocking for the Fed is it remains pretty high. It has started to slow down, but it's still at a pretty high rate, 4.3%. Go back before the pandemic, and we were looking at rates of around, less than 3% average wage growth. Maybe 3.2 would be shockingly high. But now we're looking at 4.3, and that's taking a long time to come down. So if wage growth stays high, then services inflation will remain high as well, because that depends heavily on wages. So it does look as if it's improving, wage growth is slowing, but it's still not consistent with an inflation rate of 2%, unfortunately. So now let's look at the Fed's balance sheet, because this is something that the Fed has been trying to shrink. It's got 9 trillion. It had almost 9 trillion in treasuries and mortgage-backed securities. After the pandemic, it bought lots of those assets to try and stimulate activity. And certainly it's been partially successful in trying to shrink its balance sheet. It shrank by about 7% from its 9 trillion, or just under 9 trillion, down to around 8.3 trillion. But then we had the banking crisis. And what the Fed decided to do is, instead of cutting interest rates, they decided to use their balance sheet and provide loans for these banks, reasonably cheap loans, in order to ensure that if they have customers running out of the door, they could afford to pay them. And they did this by giving their treasuries to the Fed, which would in return give them cash at a reasonable rate. I think it was just around 4.5% was the rate of the loan, and it was collateralized with treasuries. Now, that caused a spike of around 4.7% in the Fed's balance sheet temporarily. As the crisis abated, the size of the balance sheet started to shrink again. So the Fed is essentially just letting the bonds mature and not replacing them. And so this should reduce the size of the Fed's balance sheet pretty rapidly. And it's pretty much at the rate that it was reducing before now. So that banking crisis has kind of effectively become a memory for now. Now, if we look at core inflation, this is the thing that's been disappointing Powell and the committee, which is that if you look at CPI inflation, the headline, that's the blue number, of course that's been plummeting. As we'll see, it's because of energy prices falling. But if you look at core, it really hasn't fallen much at all. That's the yellow line. So it's fallen slightly. It's around 5.3% now. It peaked a few percentage points higher, maybe 1 percentage point higher, but it really hasn't fallen much. It is falling, so there is some disinflation, but nothing like the disinflation we see for headline CPI. And if we break it down into monthly components, that's on the right-hand side here, and annual components on the left-hand side, you can see the deflation which we've currently got in fuel oil, gasoline, airline fares, utility piped gas service, all of those are falling year on year, and in deflation. So those are negatively contributing to inflation year on year. But there are still things like food, like transportation services, and owner's equivalent rent pushing inflation up on a year-by-year basis. And used cars and trucks is over a month-by-month basis in May. From April to May, that was still increasing by 4.4%. But still, for these energy components, yeah, even on a monthly basis, those are in deflation. So that's clearly what's driving headline inflation down. It's energy. But of course, that doesn't contribute at all to core inflation. So that's not helping for core. For that, it's much more about wages. And the measure that the Fed actually looks at is personal consumption expenditures. That's this number. And that also has a core and a headline version. The headline version is in blue. The core version is in yellow. And you can see that there's almost no progress over the last 1, 2, 3, 4 months for core PCE. It hasn't come down. It's stayed at around 4.7%. And that's worrying the Fed. And that's made it much more aggressive in terms of its policy. And unless that changes, and unless it sees as a kind of material sign that that's falling, then it'll stay very aggressive in its monetary policy and potentially even raise rates further, as Jerome Powell was saying. Now, if you look at the breakdown of different types of personal consumption expenditures inflation, if we break it into services, that's in the top panel, durable goods in the middle, and non-durable goods at the bottom, you can see that durable goods have fallen. That was pretty much a pandemic thing. There was a huge spike in inflation as people had cash and they bought durable goods because they were stuck at home. Maybe they could buy a new dishwasher, maybe a new TV. And non-durable goods as well. That was pushed up by supply chain disruptions, which are now ebbing. And so the only component which has stayed sticky is services. And services relies heavily on wages. If wage growth is high, as we saw it is, then that'll keep service inflation high. So that's the component that won't go away. And as I say, there's no sign that it's ebbing. So that's a problem. If we look at expectations of inflation, so this is a kind of measure of Fed credibility. Do the markets think that the Fed can keep inflation at its 2% level? So the way you can do that is to look at the inflation market, inflation swaps, and you look at what markets expect inflation to be 5 years in the future, looking out a further 5 years. So this is called five-year inflation. That's pretty much remained anchored at just above 2%. So clearly, expectations from the market remain anchored for inflation, and that's really important. If the Fed is credible, if markets think it can get inflation back to 2%, then inflation won't become entrenched. It's less likely to become entrenched, which is the big fear. If everyone assumes inflation is going to be running at crazy levels for a long time, then it becomes a self-fulfilling prophecy, because companies will raise the value of their goods and services, because if they think inflation for their input costs will remain high, they'll put up their prices too. People will negotiate high wage growth because they have to, because they think inflation will stay at crazily high levels. So fortunately, that's not the case. The Fed remains credible, and that's good news. So now let's look at the tighter credit conditions, because this is one of the points of tighter policy, which is that it's harder and more expensive to borrow money. So it's really critical that the Fed actually does create tighter conditions. And there was some kind of controversy in the past because Jerome Powell was saying that credit conditions were tighter. And when he looked at some measures of credit conditions, that wasn't what we saw. So this top line number, this is a measure of national financial conditions in the United States. So when this number goes red, that suggests tighter financial conditions. And that's what the Fed's trying to do. If it goes down, that shows looser conditions. And then these three bottom panels are subcomponents of that index. Now, what's noticeable is this has been showing easing of conditions for some time, since I'd say a couple of months ago, maybe 2-3 months ago, certainly for a quarter, it's been showing easing of conditions. And that's partly because of risk. That's the middle component here. So stock markets have been rallying a lot, and that's essentially an easing of conditions. Credit conditions have been very easy. So if you look at the corporate bond market, credit spreads are very tight, and they remain tight. So the cost of borrowing remains very low for US corporates. Bank lending has tightened. So certainly if you look at things like the amount of leverage which is in the system, yes, that has shown tightening. There's less leverage. But when you look at things like credit spreads and the stock market, those have been showing essentially that markets are actually getting easier. So credit conditions are getting easier. So effectively, not what the Fed wants to see. So not tightening, okay? Certainly what this measure shows. What's interesting is that this is a measure from the Chicago Fed. So this is the Federal Reserve's, one of the Federal Reserve's own measures of credit conditions. Okay, so now we have the opportunity to ask questions. And yeah, so if you do have a question, please do ask a super chat, or if you're one of our YouTube supporters, we'll also answer your question first. And we won't answer many questions because it's quite late, and also, primarily this was just a chance to give my take on what the Fed's doing. And it was nice to see some of our members there. So I saw that Thomas Cruz there. He's one of our supporters from the South in America. So nice to see you, Thomas. And Tasty Pimp. I need to know if Ramin believes in pot noodle. I've certainly eaten a lot of pot noodles in my time, I can tell you, as a student. What else have we got here? So yeah, please do ask a super chat, or yeah, if you do have a question, so I will start to ask some of the questions now. The Informer says, hello all. Hope everyone got rich with the stock market pump. I'm not sure that's what it was, but certainly it's been a crazy rally, right? Incredible rally over the last... let's have a look at markets actually, just see what they did after the meeting. Always interesting. Often the immediate response is not what you see the next day. Let's see how markets took it. Now I'd have guessed that markets would see it as hawkish, so tighter for longer. So probably not good for markets. Yeah, kind of volatile. Initially a fall and then a rise. Yeah, not clear. So kind of a mixed message for markets. Let me just share that with you so you can see what I see. Yes, this is Koifin, and what we're looking at is the Nasdaq, the S&P, and US Treasuries over the last day. And I guess Powell started speaking here, and you can see there was a sharp market fall, not a huge fall, 0.5%, and then things very quickly recovered. So not a clear move in either direction. Eventually it kind of disappeared again. Because it was what people expected, but still I think it's pretty clear that the Fed grew more hawkish, which equity markets don't usually like. Oh, we've got some super chats, thank you. So the first one is from Eddie Ward. Thank you, Eddie. And he says, Computershare offered me a 5-year gilt at 6%. Do you think it's a good buy? I phoned them up. Okay. 5-year gilt at 6%. Yes, I think that's very good. So, I mean, think about it, right? So you could lock in a rate for 6% for 5 years. That's pretty good. And, you know, there's no credit risk. The UK government's not going to default. So who wouldn't like a guaranteed 6% return over 5 years? It's pretty good. Unless you think stock markets will do much better. Because you always have to think about, you know, competition for your capital. What's going to give me the best return for this £1 I'm investing? And if you think that markets won't return 6% over the next 5 years, then yeah, you probably think that was quite attractive. And certainly for global indices, markets have been pretty range bound over the last year. For US investors investing in the US market, a huge rally, a big rally over the course of this year. But in the UK, what we see is strengthening sterling, which is a drag on return for us, at the same time that markets haven't really moved that much. So the two have roughly cancelled each other out. There has been a bit of a rally, but not much. But, you know, 5-year gilt at 6% is pretty tasty. So, you know, I've bought a gilt myself. Let's have a look at the yield curve just to see how it looks right now. Because there has been a big jump in UK yields. Recently. Yeah, here that's pretty clear. So this is the UK yield curve. Let me make it a little bit bigger. And the green line is where we are now. The orange line is where we were a week ago. And the other line, which has an unidentifiable colour, is that brown, was a month ago. So pretty much across the entire yield curve, we've got to move upwards, a kind of parallel shift upwards. So at the 6-month point, we're looking at 5.2%. At the 5-year point, we're looking at 4.5%. So a yield of 6 sounds suspiciously high. I'm not sure whether that's right. It may have a 6% coupon, but the yield would, you know, that's probably going to be trading at a premium, such that the overall yield to maturity, if you hold it to maturity, will be 4.5%-ish. So I don't think you'd have been able to get 6% for a UK gilt. Was it a treasury maybe in the US? No, they're at 4% as well. Okay, so I think probably the yield is lower than you expect, Eddie. Yeah, but if you could get a yield of 6% for a gilt for 5 years, yeah, that sounds great. But if it's just 4.5%, not so good. And I think markets over that period of time have a fairly good chance of beating 6%, although, of course, nothing's for certain. So, you know, if you want a gilt, then if you wanted to hedge your equity, what I would say is hold it to maturity, because then, you know, you're not going to have to worry about volatility. If the price of the bond goes up a lot, yeah, maybe sell it before maturity, but lock in that rate until maturity is a pretty attractive thing to do. So what I did is I bought a 6-month gilt. Now it's roughly a 4-month gilt because I did it about 2 months ago, and I locked in a rate of about, I think it was about 4.5, something like that when I bought it. And I also bought an inflation-linked bond where I don't know what I'm going to get, but that's going to mature next year in 2024. Certainly so far it's looking like I'm going to get a roughly 7% annualized return on that, which is pretty good because inflation surprised on the upside since I bought it. So certainly think about inflation linked as well, Eddie. You might have missed the boat a bit now that inflation is coming down a bit, but really depends on what you think is going to happen to inflation, RPI inflation, over the period until the bond matures. and break-even inflation is very important there. But yeah, I think gilts are a good buy, and certainly I've bought them in my fund portfolio as a result. Next question is from Gary, who says he's one of our supporters. Thank you, Gary, one of our YouTube supporters. And he says, do your own thoughts align with the Fed? Well, do I think that there's going to be a rate cut before the end of this year? Probably not. I mean, all you've got to do is look at that PCE inflation, core PCE inflation, and I'll whip it back up just so you can see what I mean. If that stays at where it is, then absolutely not. We're not going to get a rate hike. And the Fed, in a sense, I mean, the Fed doesn't have an opinion. They just have, the dot plots are just a wild guess, really, and shouldn't be taken seriously because, they don't know what's going to happen. But look at this, right? Core PCE hardly moved at all over the last quarter, even longer. It's been 1, 2, 3, 4 months with almost no progress. And that's a real worry because that shows that certainly in terms of Fed policy, it's just not reaching this part of inflation. It's affecting headline inflation and parts of the economy which are sensitive to rates, like the housing market, like durable goods, maybe some business investment, but certainly not affecting services, which is such an important part of the US economy and which depends on wage growth. So that is worrying. But at least, we are seeing wage growth start to slow down. That is reassuring. So if we look at those earnings, they are starting to, so the blue line here, the average hourly earnings growth is starting to ease, but still pretty slowly. It's still growing at 4.1%. So, I'm pretty much in line with the Fed when it comes to being data dependent. But I think that the Fed isn't going to cut by the end of this year. I think markets are far too optimistic in a way. And a lot of the rally that we've seen so far has been just in those mega cap growth stocks, which are tech based. And I think that's an unhealthy market and maybe an unsustainable rally. So I think too much optimism based on this data point, what the Fed's done, is misguided. I think that the Fed will remain fairly tight in terms of its policy unless PCE inflation shows some sign of coming down, which it hasn't yet. So I think, tight policy for longer. That's bad for growth stocks. It's good for value stocks. So for things like income and high dividend yield, things like buy rights, that kind of thing, all of those look more attractive to me at the moment. And I think we'll go back to a kind of range-bound market once the market realizes that, the Fed actually will stay tight in terms of its policy and then core inflation isn't really coming down. So, that's my view. And certainly if you look at US valuations, they're kind of not really justifiable. So if we look at the forward price to earnings multiple, so let's look at PensionCraft's trackers because we've got one for the S&P. So again, if you remember, you get access to these. Let's make myself small over here. So these are the trackers. And the one we're interested in is US valuation. And what we're going to look at is the forward price to earnings multiple for the US. So I'll make this a bit bigger. There we go. So what have we got? We've got the S&P's close yesterday was 43.69 and is currently above the 5-year average forward price to earnings multiple. So not only is it expensive now by almost any measure you think of, it's above the average valuation over the last 5 years, over the last 10 years, over the last 60 years, based on the forecast earnings for the year ahead. And this is a forward-looking measure, right? So this is baking in some optimism from broker forecasts for US company profits. And even that's looking optimistic. So I think we should be closer to the 60-year average, certainly to the 10-year average, which is 8% below where we closed yesterday. So yeah, I think that's not right, and that makes me kind of bearish, I guess, on the US market at least. So back to your questions. What have we got? There's a question from Ray, Super Chat. Thank you, Ray. He says, any discussion for corporate profiteering by the Fed? Corporate profiteering by the Fed? Well, I guess you could say that the Fed, I don't know how you'd argue that. I'm not sure what form that argument would take, Ray. I mean, what the Fed is trying to do here is not going to help companies at all. Tighter monetary policy is not going to help them. Lower inflation will help them. But corporate profiteering, well, for starters, the Fed isn't a company, it's a central bank. So it's not worried about its own profits. And it is worried about the general health of the US economy, that's for certain. And, inflation's hurting US companies, US citizens, so I guess this will help them. Is this a question about keeping margins high and greedflation, perhaps? I mean, there is pretty good evidence that the US is currently seeing very high margins, and I did a video about this. In fact, if you look at US margins, so this is the percentage of the turnover of a company, which makes it down to the bottom line, that's the margin. And essentially, if you have a high margin, then you're giving less money to your employees, so you're paying less wages, and you're giving more back to the shareholders. And what's gradually happened since 1990 is US margins have been steadily increasing. So this isn't a new thing. Margins in the US have been rising for a long time, and they're almost at record levels now. So a company's not cutting their profits and handing on high input costs to their customers and making them pay for it. Yeah, they are. If they weren't doing that, we would see margins fall. And we are seeing earnings fall, but we're not seeing margins fall significantly, at least not yet. And, I'm surprised by that. I thought, but the reason for it is that demand for goods and services is still pretty brisk in the United States. The economy is not really slowing down. And if that's the case, then companies can get away with keeping their prices high. That's a surprising thing. And it surprised the Fed too, I think. But it's not the Fed which is engineering corporate profiteering. This is an individual decision by every company in America, whether they take a hit and reduce their profitability and make life easier for their consumers, or whether they force the consumers to take a hit by keeping their prices high. So at the moment, nobody's taking a hit because wage growth is still high. Real wage growth is negative, which isn't good. But nominal wage growth is pretty high in the US, which is showing that US consumers also are, not willing to take a hit either. So at some point, somebody's got to take a hit. And this is the point that the Bank of England made very clumsily, which is that at some point, somebody has to admit that they're poorer, but nobody wants to admit it or concede it. So companies don't want to lower their margins. Individuals don't want to have lower disposable income, so they negotiate up their wages. So that's a problem, right? At some point, this has to end one way or the other, or both. Companies and individuals have to accept being poorer. There we are. I channeled what the Bank of England was saying. Hugh Pill. Right, next question is from Amir Ketobchi, who's got a Persian surname and first name actually, who's given us a super chat. Thank you, Amir. Merci. And he says, just wanted to support you in your channel. Thank you. That's really kind of you. Could you say a little about your YouTube workflow? How you film your videos? Very painfully, I have to say. And very hot at the moment as well. So I do have a fan working in the background. But you actually can't tell, but I'm not wearing any trousers. I'm just in my boxes here. but Laura told me to put a shirt on, right? So that's part of the process he probably didn't want to hear about. But, what's the workflow? Well, I mean, certainly the planning and the kind of data analysis takes about a day for a video. So, we come up with an idea, we look at what's happening in markets, we look at what's interesting. There are certain topics we covered regularly, and then some things that we just base it on news. Now that we do the podcast, Many Happy Returns, which I have a co-host, Michael, that often triggers ideas, and the community often triggers ideas. So that's been great for content generation, because they have really interesting ideas and questions, and that often forms the kind of grain of a new video for a topic. And then I have to kind of develop the idea. That takes about a day. I have to collect data for it, because I don't just spout crap. I try to ground it in data, and that takes a while to make the graphs and make them look good. And sometimes it doesn't tell the story you think, so you have to change the story. So that's about a day, and then I shoot it. And now I've got a brilliant video editor, Arslan, who I send the video files to, and he edits the video. That takes about a day, and then off it goes to members. So members see it first, they see a preview, and then it gets posted to YouTube. So that's the kind of workflow. But in terms of the tools I use, it's almost all open source stuff. OBS for shooting, I'm using OBS now. I use Ubuntu as an operating system. I use Kdenlive to edit the videos. And Arslan, I think, uses Adobe tools to edit the videos. I'll have to have him on one of these live streams, because he's great. He's an amazing editor. He's really improved the quality, I think, of the videos. And he also produces the thumbnails. So that's the process. It isn't pretty, put it that way. Anyway, that's how we do it. That's how the sausage is made. So I think we'll stop it there. I think, we've been going for quite a while now. But thank you all for joining us. Don't forget, we'll be covering the Bank of England next week. So I'll be listening with rapt attention to what Andrew Bailey has to say. And please do subscribe to our channel if you don't want to miss any new content, and if you like our stuff. And don't forget our membership if you want access to those tools, to our explainers, to our chat channel, so you can ask questions whenever you want, and all the other goodies that you get from being a member of our online community. And if you want to learn more about that, just go to PensionCraft.com. And so thank you all for joining us, and tune in next week if you want to hear what the Bank of England has to say. Take care, everyone, and good luck with your portfolios.